Hello, welcome to part 2 of this class. And in this class, we will talk about choices. Yes, life is full of choices and life is unpredictable. So is stock market, and that's why from day one, when I introduced the stock market to you, all I told you is businesses is all around you. It is related with your life and businesses represent the stock market at the end of the day. And I have been focusing and telling you again and again that you need to know more businesses. Well, here I'm not going to talk about the business in this class because we are just at the start of a quantitative finance, quantitative fundamental analysis class. In last video of this class, you learned about what choices a businessman have, right? Yes. So there is a guy who is a very good chef. He thought of becoming a snack seller, opened one shop, and he has multiple choices to grow his business. And when we saw that the choices which he had, based on those choices, his company would have become 15 lakh rupees company from an investment of 1 lakh rupee in 5 years. Why not we open that Excel sheet itself and look at the choices that businessman had. So we saw that in business case 1, he opened the shop, he focused there, and he kept on saving the money which he was saving through that business, and in 5 years he was able to make it a 15 lakh rupees company, where 15 lakh rupees is the saving of this company, and is still having this business. Not a bad return, it is his choice. Then he could have chosen to go to a banker who would have made a projected report on a 25% profit growth on 1 year and could have projected even 652 crore company and raised early money through IPO and could have made it even $1 billion company, right? So this could be his second choice, but we saw that this was little unrealistic. Then we saw third choice, which was more aligned with how you and me both think, where for 5 months he go on a simple interest, he save that money, then he try to compound for 2 3 months, then again he sit back and relax. Then at one point of time he decided that okay, fine, I'll just open 2 shops in a year because that is something which is feasible and I'm able to do it properly. And then he realistically make, let's say, 50 crore company or 5 crore company with just 1 lakh rupee. What I was trying to tell you, that by having different adjustments, which is again based on the choice of that businessman, he could have made this a company at any scale. He could have closed it also because he was trying to take some extra risk. Anything could have happened, right? So at the end of the day, at the end of the any decision which you make out of all the choices you have, it may go right, it may go wrong, but the point here is we always want to make informed decision among all the choices we have, right? And there obviously numbers help us as well. And that's why I have just opened Excel sheet and told you from a perspective of a businessman. Now in this class, in this part of this class, we will see if you have such choices. Okay, one of the choice you would have had here is, this guy started the business with 1 lakh. You tested his snacks. You would have told him, boss, why don't you make me partner with 1 lakh rupee? I'm putting 1 lakh rupee. You can see and forecast it. That power of compounding will work in his favor. He may open 5,000 shops in 500 different districts in India and can become a food giant, big food giant, and you can take 50% of their stake. You could have offered it, right? Because this is the choice always you have when you think about investing into stock market. You can also find out one of the entrepreneur from your locality and put your money with him also, right? You have another choice, that instead of doing a job, if power of compounding is so powerful and you also know about certain businesses, you can start one business as well. Yes, I'm promoting entrepreneurship here, right? The best investment decision which anyone can take is invest into his own business, no doubt about it, right? But then we all have our own apprehensions and our skill set, comfort zone, and on the basis of that we have chosen certain profession. And in that profession again you are helping one or the other entrepreneur, so it is fine even if you don't take up that role and passively invest into others company, but then those others company also give you a number, and based on that number you can take an informed decision, right? So one of the decision was like you could have gone with this guy and invested your money with this person who has just opened his snack shop and made your multiple time return, and then this guy would have had a choice that he would not take that 1 lakh rupee from you and think that anyway I'm making 25,000 rupees per month. Instead of taking and making him a partner, let me work hard for 4 months and open the second shop on my own money, because he also now probably understand power of compounding, right? So he could have waited and he would have just refused you. But then there could have been another way, and you would have said, okay, fine, not 1 lakh, I'll give you 5 lakh rupees and then you make me 50% partner. So this guy now may think, okay, fine, the business worth is just 1 lakh. This guy is giving me 5 lakh rupees for 50% partnership, means he's valuing my business 10 times, 10 lakh rupee. Then he might have thought, okay, fine, I'll give him 50%. Still, you would see that your 5 lakh rupees has grown tremendously, because even if it has become a 5-10 crore company, your 5 lakh will become 5 crore, right? 50% partnership. So this is what are the different choices you have, and a businessman also have that choices, and it's a marriage between both of these guys, the businessman and one who wanted to invest into his business, is where the stock market gives you a platform. I know I'm talking a very noise and layman language, but I feel that before jumping into anything complicated, this basic stuff everybody should understand. And that's why I have always re-record this portion and bring some real life example that this is what is happening, and you have 4-5 choices. Out of those 4-5 choices, what is that you will take, right? So one was something which is not a listed company, obviously one hypothetical example I have taken, but in this part I'm going to give you 4-5 choices. When I'm explaining this, you can start visualizing and see that where exactly which choice you want to go and make out, so for that I'll open the other sheet. Yeah, so let's say you have choice number 1 is put all your money in FD rupees, and let's say you have this 100 rupees, right? Future value formula and everything. You could have calculated, you could have opened your compound interest calculator on internet, which I have shown you again and again. But then just because I wanted to give a very real picture, I have made this sheet for you, and I'm not gonna attach it in the because I want you to work, then only you will learn. So I'm not gonna attach it. You have to make it. So from this time onwards, you better see what are the formula I have used, and you make your own sheet, okay? And it will also become your sheet, your master sheet, when you prepare for 4-5 companies analysis. This is not a complete analysis as such, on the basis of which you can take decision and start buying stocks, because if you see, I have taken certain code. This code is F, this is R, this is H, this is T, this is C. So out of these 5 choices, I have given them a code, and I'll tell you that what this code means at the end of when I have explained you. So choice number 1 which you have is, on year 1, this 100 rupees you have deposited, and at start of the year 2 it will become 107 rupee. Formula I have used is very simple: B4 into 1.07, which means it is giving you 7% return. Current FD rate I have taken, and then I simply have copy pasted, so this 100, and this is 100 into 1.07, B4 into 07, this will become B5 into 1.06. it has become, because initially I had taken that 1.6. so all I'm doing is I'm changing in front of you only, right? So you can see the numbers are changing, and I have taken it for 20 years. So this is year 20, and in 20 year your 100 rupees is becoming how much? 361 rupee. Where? FD. Yes, you have FD, and in this FD your 100 rupees at 7% is becoming 361 rupee. Now FD is the rate at which you give your money to the bank. Now what bank does I have explained you in the basics. Bank give this money to businessman, probably at 12%. And why a businessman take money at 12%? because he's involved into certain businesses where he should be generating more than 12% on the capital which he had, the existing capital. So to grow the business, he has to bring more capital. He can bring it through debt, he can bring it through equity. Equity is the money which you give as a stock investor when you apply the IPO. Done? Right. So here you had this choice that you'll put all your money in FD, and in 20 years you will make 3.61 times return, which is 361 rupee. Then you have choice number 2. In this choice, there is one guy who comes and he tells you that I'll take your 100 rupees and I'll invest this into one company which is having a book value of only 65 rupees. I think I have explained again and again book value, but again I'm explaining you. So book value per share is something what you will get as a shareholder if company overnight thinks that they will sell all its asset and give all the liability to, pay off all the liability. Asset is what they own, liability is what they have to pay. So they have building, structures, everything. They said that, okay, we will sell everything and pay off all the loan, and whatever is the money left, we will equally distribute among all the shareholders. So when they distribute it to all the shareholders, the money which you will get as one shareholder is the book value. So he's saying that, okay, this company is making a return on the capital which they have at 12%. So company actual worth, which company itself is declaring, which is the book value per share, is 65 rupees. But then, since it is making more return than 8%, 7%, and probably it has taken loan just on 8 or 9%, so extra 3% they are generating even after the loan and everything. So this company is bound to grow, right? So this person tells you that, okay, my company is 65 rupees valued. The way this guy shop was valued only 1 lakh rupee at the end of the month, but he made you partner after taking 5 lakh rupees. That's where the marriage of a businessman and an investor happened, because he's also going to put his effort, his skills. He got a proven business. So here you have one choice again. And this is a choice where he says that, okay, my book value is 65 rupees, but then I'll charge you 100 rupees if you want to make one share. Now you will think that, okay, since the book value is 65, company will grow at 65 at least, but the growth of rate will be 12%. So what will happen? In year 2, you will see that it becomes only 72 rupees. Year 3, it become 91 rupee. So even it will take 3-4 years to come to the rate where your actual money you have deployed has come. So even it is on 100, for 3 years it has not reached even 100 rupees. What if it at third year is to stop making any profit? So businesses are uncertain, so is life. You will lose all the money. But what if this company for next 20 years keep on making money for you? So even when they have given you something which worth only 65 rupees by giving you 100 rupees, this in 20 years will become 4,000 rupees. So there you will say that, okay, now the company is having 4,000 rupee. When on per share book value, when it was 65 rupees, it asked me a premium of 1.5% almost. That point of time, since it is growing at that rate for 12%, instead of putting in FD, it is going to become a minimum 4,000 rupees the book value, and maybe share that time will not even demand any premium, or may demand double of the premium, or even 3 times of the premium. So I'll making at least 10-15 times more return if I'm putting in this company, which is just growing at 12% instead of 7%. So you see that how strong is power of compounding. This is what work in the businesses. So even with extra 5%, this company has a potential of making big money for you, right? Now, I'll talk about choice 2, choice 3. In choice 3, what he says that, well, my book value is only 36 rupees and I will give you that in 100 rupees. So you had choice 1 where you put your money in FD, choice 2 again 100 rupees into one company, choice 3 this time you put 100 rupees in company 3, but he gave you the authority of just 36 or the piece of just 36, one piece of the share of which actual value book value is 36, but then this company is growing at 17%. Now when I keep on compounding the same, this become 1100 rupees, still three times more than the FD rate. Okay, so just because it is demanding more premium means three times almost 2.8 times, what you can see that the rate of return is higher and that's why probably it is asking more premium. This is what is the quality thing. So something which is having a better quality is asking you better premium also. However, when you calculate and you see the same rate for next 20 years, then you find that this is not a better buy than choice number 2. But then if you compound it for 50 years, this is one exercise you can do. So when you compound it for 50 years, you will see that this extra 5% will beat it, the choice number 2. And that point of time, the people who are doing the valuation will justify it. That okay, even after three times of the premium, since I'm going to sustain for next 50 years and keep on growing with the same rate, with the projected value, I can always ask a better premium. So this was your choice number 3. Let's say we have another choice. In this choice, this guy is growing at 35%. 35% on the book value, let's say. The company, the capital which is there, the book value, 35% growth. And he's saying that, okay, I will give you one share of mine, but it will worth only 15 rupees as per the book value for your 100 rupees. Now you will again make a calculation and you will see that this is becoming 6,000 rupees. So even when you are giving 6.2 times, 6.3 times of the premium, you are still making better money if you are stay invested for 20 years and this company keep on growing at the same rate. So 35% return, if it is giving on capital deployed, it means its sales is also growing at the same rate. Profit is also going at the same rate, not exactly the same rate, but at the end of the day, the profitability is sustaining for next 20 years, right? Then you have choice number 4, 5. In this choice, this company is growing at 75% and it is asking only 2% premium. Now, something which you have to see is here choice 4 and choice 5. Now in choice 4, and so it is not going to be that simple because I'm giving you all these real examples of the company. Here you have one company which is asking you more than 6 times of the premium and growing only at 35% of the capital they have. However, here you have one company which is giving you 75% return on the capital they have, but they are asking just 2.2% of the premium. So is it possible? Is it that easy to compare two such companies and take a decision and call that this is good company or this is bad company? No. You have to learn more. You have to learn the again businesses, that in which businesses they have. So now I'm going to reveal you the name of the companies. So this is Reliance Industries. This is HDFC Bank. I'm taking only the large companies so that you can, why I've taken a large company example is there is a reason. You can trust these companies more than the small companies in terms of the number they are giving or they are declaring. So these book values are declared numbers from these companies only. These returns are declared numbers audited and they are big companies audited by good firms. There's a very less chance that they will manipulate. That's why I have taken these numbers. So this is HDFC Bank. This is your TCS. And this is choice number 5 is Coal India, right? So if I go and show you these companies on a screener, you have HDFC Bank. So see, price to book value is 2.74. This is what I have taken into the example. This 17% is the return on that equity or the capital which they have. So this is the number which I have taken. However, what I want you to do is not take the numbers from there, but do a very simple exercise here. And that simple exercise is you yourself calculate what is the price to book value by taking book value from here and dividing it, and taking the current market price and dividing it by book value, and then with the same fraction you can also see that what would be the market capitalization as per the book value. Market capitalization is something which is outstanding number of share into current price, right? So current price, when you calculate, you get the market cap. But what I'm saying that don't get the market cap, but get like to price to book multiple, what exactly is the net worth right now as per the book value into total outstanding number of share, what will be the this firm worth. And when you see this firm worth, what you can go and do is also see their profit and loss statement, which is annual profit TTM. Obviously I'm going to discuss all these things in the upcoming classes, especially on the screener, but it is a simple tool. You can still do this exercise and you can see that what is the net profit this company is posted. I mean, net profit is the last column here, so for the last quarter, last year, you can always see that what exactly is the, and then you can do that. If that is the profitability and this is the current value for the firm, you can always come up with what is the return they are giving on the actual worth. Because you know what, even after market has corrected so much, if you will see that HDFC Bank is having 4,20,000 crore company, its total profit is 26,000 crore. HDFC Bank has corrected by 30%. When I'm recording this session, it has crashed by 30%. So even after correction, it is a 6 lakh crore 4 lakh crore company, and this is posting 24,000 crore profit. Now what is there to understand? If a company is giving me just 6% return, so market cap is this much, 4 lakh crore, and I think TCS is a very good example to show. So if I go and see TCS, it is 6,40,000 crore company. If you go and see TCS, even after 32,000 crore profit, if you see, what you understand is 5% is the return on market capitalization is what the profit is. So you will never find it sensible. There are many other companies whom you will never find, ITC, if I take, it's 1,84,000 crore company. Net profit is 14,000 crore, right? So in some since they have crashed a lot, it looks like they make sense that they are making a good return on the market capitalization even. Otherwise, in a normal market, you will see that they will make sense like they are making only 2% of the market capitalization or 3% of the market capitalization is the number you will see. So something which you have to understand here is you have to identify that what is the net value of the company as per the book value, and on that how much money they are making. And then other choices which you have is, or the other visualization which you have to do is, are these companies going to grow for the next 20 years at the same rate? Yes or no? Even if that industry has that a scope or not, right? What could be the other qualitative factor where these companies can fail? So these are not a standalone a visualization which you can do and simply go and invest, but this is a very good way to see. You will never find that in this kind of visualization someone is teaching you to compare two companies. This is one methodology I always take up to explain some of the people and explain to myself also, right? That whether I should buy this company this expensive or not. If I compare it with the FD for how many years from today, it is going to give me the similar return what FD is giving. So if I see choice number 2, Reliance, and if I see that for next 5 years, even with the same rate, and if even if this business don't grow after 5 years at the same rate, I would still see that staying into FD is safer. But then for 20 years, I find it much profitable, right? So something you have to remember is power of compounding work only when you stay there for a very, very long term. And that's why when you are deciding to become one of the investor into stock market, always think about for the long term. Then only these choices will make sense against FD. Now, the exercise which you have is take up as many company you want to compare. Take this book value and market price ratio from here, price to book value. So divide it this by 100. If you divide 100 by 3.15, you will get certain numbers. So this is this is let's say I take TCS. So TCS is 6.72, right? So if I divide 100 by 6.72, what I get is something like 15. So 100 divided by 6.72, it comes down 4.88. I have taken 15. So you also do one exercise. You see that what is the return on equity they have posted and price to book value, and then do a different comparison and see that in longer run, even on the book values, how these companies are growing. In HDFC Bank, obviously banking industry claim that they are going to get compounded for next 50 years. Banking will not change. Nothing will change in banking for next 50 years. And that's why they demand better premium. However, a company like TCS may face a big threat in near term also, right? Still, TCS is demanding a very good premium. Very handsome profit being posted by Coal India. But still the premium is just 2 times. Because they know that there is a lot of inefficiency. The market knows there is a lot of inefficiency being a PSU, right? So qualitative analysis is something very important. My agenda was to explain you people from a businessman perspective and from an investor perspective that how many choices you always have and how you have to bring numbers and understand those numbers in a tabular form like this first before going deeper into learning about balance sheet, profit loss statement and other things, right? So yes, this is how the introduction of quantitative fundamental analysis ends. We'll jump to the next chapter and understand quantitative analysis from pure theoretical perspective, which is understanding different financial statements. Thank you.